Good evening and welcome to the August 9th edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. My name is Dr. Tisa Silver Kennedy, and I thank you so much for joining me this evening. Before we get into the questions that have been submitted by our community, I just want to share with you a bit about office hours, a bit about the center, and then we'll share some updates about some recent changes that have been pushed out by the Department of Education. And from there, we'll get into the questions that have been submitted. So bear with me for just one moment and I will share my screen. Okay, so once again, welcome to Office Hours. As for the center, the Maryland Center for Collegiate Financial Wellness was founded in 2021 with the vision to help all college and career school students in the state of Maryland achieve these 6 pillars of collegiate financial wellness. Those are being creditworthy, ready, resilient, empowered, successful, and thriving. We are doing our best to help Maryland students build their financial life skills and empower them to thrive. If this sounds like a mission and a vision that you can support, please do visit us online at mccfw.org/support, and you'll find the different ways that you can engage our community. As for office hours started in December of 2021, and that is our free semi-monthly virtual student loan clinic that provides borrowers with a trusted venue to help them navigate student loans and prepare for financial success beyond repayment. Before we get into the questions from the community, I do have to share a disclaimer, and that is that office hours is shared for informational purposes only, and it should not be construed as financial or legal advice. We do our best to give you the most accurate, up-to-date information available at the time of our broadcast, but there's never a time when you should just hear something from this broadcast and then go out and take action. You want to make sure that first you assess your loans, assess your financial circumstances, and combine that with the information that you hear from us, as well as the information you receive from your lenders and servicers, and then make an informed decision. So we're here as a service, but this should not be construed as personalized financial or legal advice. So on to a more positive subject. I wanted to provide you all with a July 2023 update for our public service loan forgiveness victories. So far for the month of July, we have had borrowers report back to us with victories worth $435,296. So those are people who were able to meet that 120 qualifying payments mark and have their debts discharged in the month of July. I'm sure that there are many more. We've got to circle back and check in with some other people. But if you have participated in office hours or had one-on-one advising from the center, I'd encourage you, please do report back. Give us a status update on your PSLF application. And please, if you have experienced the victory and you crossed that finish line, let us know, because we would love to celebrate those wins. All right, so there have been some other updates that are going to affect the experiences of current borrowers. And so I wanted to go through updates that have taken place in 3 different areas. One is the consolidation application. The second is the loan simulator. And the third is related to the IDR adjustment. So let's go through these in order. The consolidation application changed. I believe this was around July 31st. I actually had an appointment with a borrower and we were working through the application, and the start of it was completely different. The order of the questions has been changed. If any of you have completed a consolidation application before, you'll know that when you after you first hit the start button, you see a list of your loans and you have to uncheck a box to select loans that you don't want consolidated. But with this particular borrower, we started off and immediately went into personal information. And personal information is usually something that doesn't have to be entered or verified until the end of the older consolidation application. So things have shifted around, and having been through it maybe 3 or 4 times since the changes have been implemented, it does flow much more smoothly. So I'm glad to see the changes. Would have liked some advance notice so that I could have, given the borrower a heads up, but it's all good. So the order of the information has changed. The other thing that we noticed is that the new repayment plan, which is really just an updated version of an existing repayment plan called REPAYE, or Revised Pay As You Earn. The new plan is called SAVE, and SAVE is now included in the direct loan consolidation application online. So this application I'm referring to is the online application that's available at studentaid.gov. If you're going to consolidate your loans, you definitely want to go there to complete that application, and you'll be able to see those new updates. So let's move on to the next subject, which also has to do with this new version of REPAYE, which is called SAVE, and that's the loan simulator. The loan simulator is also located at studentaid.gov, and the loan simulator allows you to see what repayment will look like under different scenarios. The loan simulator is a tool that can be used if you are in repayment already, if you're about to enter repayment, or if you haven't borrowed yet and you want to project what repayment would look like if you borrowed a certain amount of loans. Now, prior to, I guess this was July 31st, on or around July 31st, we've been hearing a lot about this new repayment plan. SAVE is coming and how it's going to cut payments by more than half, but we hadn't seen it yet. And you know that I'm kind of the mindset that when it comes to the money, I need to see it, to believe it. So we knew it was coming, but we just didn't know how it was going to look like. What it was going to look like. So SAVE is now available to look at on the loan simulator. So I just wanted to share with you an example of what SAVE would look like. SAVE is the new name for REPAYE. So REPAYE is Revised Pay As You Earn, and REPAYE takes 10% of your discretionary income and dedicates it towards your student loan payment. SAVE, once it's fully implemented in July 2024, is supposed to take that payment even lower for people who have undergraduate loans only. It would drop down to 5% of their disposable income. But I just wanted to show you what SAVE looks like versus the standard repayment plan. So the standard plan is, a 10-year plan that's out there. In this case, we have a borrower paying about $242 per month, and they would be done in July 2033 if they started repayment today. For SAVE, you'll see that amount is lower because it was based on the income of the individual. And I believe in this circumstance, I put in $45,000 for a single taxpayer. That payment is $102, and it ranges from $102 to $118 over the course of 20 years. So right away, you can see how SAVE would be considered as more affordable. So if you're wondering what repayment would look like, please do go to studentaid.gov, take a look at that loan simulator, and play around with it so that you can see the estimates of what repayment will look like under different plans. All right, and on to the IDR adjustment. During the last edition of Office Hours on July 26th, I mentioned this milestone date of August the 1st of this year. And that was in reference to the rollout of cancellation for people who have reached that 20 or 25-year threshold for income-driven repayment cancellation. That date has been updated. It is now September the 1st. So if you reach the forgiveness milestone, that's either 20 years or 25 years in repayment, depending on the types of loans you have and the repayment plan you were previously enrolled in, you should expect to see your loans discharged before student loan payments restart in October. If you reach that forgiveness milestone on or after September 1st, the Department of Education says you will likely have to start making payments after the payment pause ends. But don't worry, you'll get a refund for any payments beyond the number you need for forgiveness. And as I mentioned before, during the July 26th edition, we shared the original date, which was August 1st, but now it looks like people have more time. So we're going to be looking out for September 1st. There are also some other things going on with the IDR adjustment that could affect future implementation of this cancellation for borrowers. And that's the next subject that I wanted to speak with you all about. And that is a lawsuit. So there's been a lawsuit filed to block further loan cancellation that would be offered through the income-driven repayment adjustment. I have not read the entire lawsuit. I read a bit about it. And from what I've read, there were two things that stood out to me that the plaintiffs took issue with. One is the fact that the IDR adjustment counts periods of non-payment as qualifying. An example would be a lengthy forbearance. Under the IDR adjustment, as well as the limited PSLF waiver that preceded the adjustment, lengthy forbearances could count toward public service loan forgiveness and give a person credit toward income-driven repayment. The issue here is that forbearances over the life of a loan were not supposed to be more than 36 months. And continuously, a forbearance is not supposed to be any longer than 12 months. So 12 consecutive months or 36 cumulative months. And we have seen many people who have forbearances that went well beyond both of those limits. And having forbearances that are lengthy just leaves more time for interest to accrue and for balances to grow. So with the IDR adjustment, one of the provisions was that if you had one of those lengthy forbearances that violated the rules, those months of forbearance could count toward both public service loan forgiveness and IDR cancellation. So this particular plaintiff has an issue with these periods of non-payment being counted as qualifying. The second thing that stood out to me was that the plaintiffs alleged that the plan was arbitrary, and I think the other word they used was capricious, and that the plan should have gone through the negotiated rulemaking process, and it did not. So they have issues with the plan and have filed a lawsuit to block it, as well as a temporary restraining order. So I will definitely be staying tuned to see if that restraining order is approved and what happens with the lawsuit. And I just want people to be mindful in the meantime that the lawsuit does not affect SAVE, which is the updated version of revised pay as you earn. There's some parts of SAVE that are similar to the IDR adjustment. However, SAVE itself is not included in this lawsuit. SAVE did go through the negotiated rulemaking process. The lawsuit also does not affect PSLF. Now, there are parts of the IDR adjustment that would benefit people who are applying for PSLF in that they would get credit under the current rules for periods of non-payment that are currently considered as qualifying. But the program, Public Service Loan Forgiveness itself, would not be affected by this lawsuit. So definitely we'll definitely stay tuned, and we'll report back anything we see on this front. All right, now we can finally get into the questions that have been submitted from our community. The first question has to do with Parent Plus loans. Question is, I have federally held Parent Plus loans dispersed in 2013. They have never been part of an IDR repayment plan. If I pursue the double consolidation loophole, but the consolidation process is not completed before the IDR adjustment, will the payment count reset when the consolidation process is completed? I am not eligible for PSLF. This is a lot of a question to start off our questions, I must admit. So before I actually answer the end of this question, which was about the timing of the consolidations, I want to walk you all through what a double consolidation is and what the loophole is. So when it comes to consolidations, let's just start there. With a basic consolidation, people can have a few goals. Sometimes people have several loans and several servicers, and they want to put the loans together so that they can have one service or one payment. For some people, it's affordability. Perhaps their payment is too high, and the only way for them to get a lower payment is to extend the repayment term. And when you consolidate a loan, that resets the repayment clock and stretches out the term. So if you have been in repayment for 10 years, the payment's now too high, income-driven repayment doesn't help, you could consolidate, get a new loan with a fresh 25 years, and the fixed plan should give you a low payment. Also, people can gain credit for past payments that would not have been eligible for income-driven repayment and or public service loan forgiveness. So there are several motivations to consolidate. But for Parent Plus loan borrowers, the options have always been limited. So if a Parent Plus loan borrower consolidated their loans and they were looking for public service loan forgiveness, there's only one repayment plan that they could enroll in that would keep them on track for PSLF. And that plan is known as ICR. But the double consolidation loophole would allow a parent to consolidate their loans more than once and gain access to multiple income-driven repayment plans instead of just ICR. And within those repayment plans, there's a plan called pay as you earn. And pay as you earn reduces the repayment term from 25 to 20 years. So having more repayment options and potentially a shorter repayment term could be possible motivations for parents to pursue this double consolidation loophole. So let's walk through what consolidation would look like before the IDR adjustment and then during the IDR adjustment, because that's what this particular Parent Plus loan borrower is concerned about. So before, let's say we had a person who had 2 Parent Plus loans, and those loans had been in existence 110 months. I was thinking back to their 2013 disbursement date. So let's just assume 110 months. Before the IDR adjustment, if the parent took these 2 loans and consolidated them together, they would have a new consolidation loan, and that new consolidation loan would have 0 months of credit for that 110 months of repayment history. So they would literally be starting off fresh for public service loan forgiveness and income-driven repayment if they were pursuing both of those. Now, during the IDR adjustment, you can take those same 2 Parent Plus loans with 110 months of history, consolidate them together, and they become one direct consolidation loan that now gives credit for the 110 months of repayment history. Either way, if this person is pursuing cancellation by way of income-driven repayment or public service loan forgiveness, they still only have one repayment plan available to them, and that is ICR. And ICR is usually the least affordable income-driven repayment plan. So, how does this double consolidation loophole work? Really, it's not 2 consolidations, it's 3, but here's how it works. I'd like to think of it in 2 phases. Round 1 is where you look at the loans that you have and you would separate them into 2 groups. Then you would take each of those groups and consolidate them with a separate servicer. You would also have to submit an IDR request with those consolidation applications so that you could get enrolled in an income-driven repayment plan and consolidate the loans. But it's important to keep them separately. The second round, after those initial loans have been consolidated into Group 1 and Group 2, you would then complete the consolidation application again to consolidate your consolidated loans. And then you would do that with another servicer and submit another IDR request application so that you can get enrolled in an income-driven repayment plan. And I'm going to walk you through what this looks like. But in order for it to work, you have to have more than 1 loan. If you only have 1 loan, there's no way that you can do the double consolidation. You also have to complete 3 consolidation applications, 2 of them in round 1 and the third one in round 2. You also need to have 3 different servicers to work this through. So let's take a look. In this example, Jay has 3 Parent Plus loans. Loan 1 is for $19,000, loan 2 is for $15,000, loan 3 is for $20,000. In the first round, Jay would need to separate these loans into 2 groups. So I'm going to call them Group A and Group B. Group A has the first 2 loans, Group B has the third loan. The next thing Jay would need to do is take Group A to one servicer, apply for consolidation, and also apply for an income-driven repayment plan. Group B, do the same thing, except with another servicer. And the recommendations that I've seen out there about this are do this on paper. So submit your paperwork because you're going to be sending this to 2 different servicers. You wouldn't be able to do, I don't think you'd be able to do both of these online, but I haven't been through this, so don't quote me on that. But after these loans go together, you now have 2 consolidation loans. I'm going to call them direct consolidation loan 1 and direct consolidation loan 2. Now, Jay started with 3 Parent Plus loans, but after round 1 of consolidations, Jay now has 2 loans, and they're both direct consolidation loans. The second round of this would be to take direct consolidation loan 1 and direct consolidation loan 2, consolidate them together with servicer 3, and apply for income-driven repayment as well. Once that takes place, it's like the coding of the loan changes. It's no longer associated with a Parent Plus loan. It's a consolidation loan. And because it's a consolidation loan and not a Parent Plus loan anymore, that opens the door for access to these more favorable repayment terms. So let me show you what it looks like. Group A, we had those 2 loans, 110 months of history. Put them together, they keep their 110 months. We'll assume Group B was taken out a little bit later, 98 months of history. We consolidate that loan by itself. It becomes a new consolidation loan that has 98 months of history. If J were to stop at this point, this would not have helped, because in both cases, ICR would still be the only income-driven repayment plan available for either of those direct consolidation loans. That coding of a Parent Plus loan is still there. But once J takes this to the next level, we have direct consolidation loan 1, direct consolidation loan 2, put them together, and that becomes direct consolidation loan 3. Also, that second loan that only had 98 months of history gets sped up to the pace of that first loan, which had 110 months of history. So J has gained some progress toward IDR cancellation. Additionally, and this is probably the reason why a lot of people want to do this, is that you have access to more affordable repayment plans. So in this example from the loan simulator, I assume that we have a Parent Plus borrower who is single with no dependents and an adjusted gross income of $70,000. If J stops at round 1, that's where J has direct consolidation loan 1 and direct consolidation loan 2. There is one option for income-driven repayment, and that's income contingent repayment, which would be $588 per month. J could take the standard plan, which is fixed for 25 years at $421 per month. Now, if J goes through to round 2 and completes that final consolidation to bring all the loans together into direct consolidation loan 3, the standard plan is still $421. That's not going to change because it's based on the balance of the loan. ICR is also not going to change. We already know it's $588, but now J could potentially enroll in pay as you earn or save, the new version of revised pay as you earn. And from the loan simulator today, pay as you earn, if J is eligible, would have a first year payment of $401. So that's more affordable than ICR. If J decides to enroll in save, then the monthly payment in the first year would be an estimated $310. So right away you can see $310 versus $588. Who wouldn't want the $310? So this is why people pursue the double consolidation loophole. It has multiple steps. I won't say that it's difficult, but it has multiple steps, and you want to make sure that you do it right so that you stay on track to get the benefit of it. So this particular Parent Plus loan borrower had a question related to the timing of completing their application. The IDR adjustment, the benefits of that adjustment are going to be the most generous if you complete your application to consolidate by December 31st of 2023. So there's still more time to get this done, even when you're doing 2 rounds of consolidations. You want to keep in mind, though, when you do this, the payment counts temporarily reset to 0. And this is something that a lot of people who are on track for public service loan forgiveness see, and they know it's coming, but it's still a shock to them because they've been in repayment for a long time. And then that first payment count comes and it's like you have 2 payments. And like, what? You know, I've been in repayment all this time and I only have 2, but it's because you just consolidated. And that first count always looks at the history of the most recent loan. So for this parent, if you were to start this process today, usually consolidation loans, I believe they quote you at about 45 to 60 days after the application is submitted. I think that's for the online version though. So with paper, it might take longer, but you're probably looking at about 2 months before the consolidation loan is dispersed. So if you complete that first application starting now, you probably have that new consolidation loan by early to mid-October, and that would still give you time to complete the application for the second round of consolidation before the IDR adjustment, that most generous benefit period of the IDR adjustment expires on December 31st of 2023. The second cycle, though, I've seen recommendations to complete that online, so it should move faster, but you've got until December 31st to get it in for the greatest benefit. And I just wanted to share a quick note about this loophole. The loophole is something that, of course, the Department of Education is aware of, and President Biden has some rules that are set to eliminate the double consolidation loophole after July 1st of 2025. So there's still plenty of time to do it, but this is not something that is going to be out there for the long term. So at this point, to this parent, I would say, if you're serious about it, if you have enough loans and it would make that big of a difference for you, then you do have time to complete both of those consolidations and get them in before this most generous period of the IDR adjustment expires, December 31st of 2023. All right. Next question is, I'm a longtime community college staff person and want to find out if my graduate loans are eligible for public service loan forgiveness. And if so, how do I apply? Well, I'm going to walk you through public service loan forgiveness, but I always want to come back to what the employment means. When it comes to employment for faculty, there are differences in the way that you would handle your application if you are full-time or if you are an adjunct. But either way, qualifying employment for PSLF has to be direct, and it has to meet this threshold of at least 30 hours per week on average. And sometimes people are a little bit confused about what it means to be a direct employee. If you received a W-2 when it's tax time each year, then you can know that your employment is direct. But if you're an independent contractor and you receive a Form 1099, then you're not considered a direct employee. As for the 30-hour per week threshold, this could be from one job or from a combination of jobs where you work part-time hours, but all of the employers you work for are qualifying. So if you have overlapping part-time employment for more than one qualifying employer, if the hours are added together to reach that 30-hour threshold, then that's okay. For adjunct faculty members, I just want to give you a little bit of clarity here about calculating your hours, because sometimes, and I'm speaking from the experience of having been an adjunct faculty member, our course loads shift. So we might have, a 3-3 one year, and then the next year we only get a 2-2, something like that. But in any case, for every credit hour that you teach, for the purposes of PSLF, your employer should use 3.35 hours worked per week. So if you have a 6 credit load during the fall semester, then you can enter 20 hours on your PSLF application, because that's 6 credits times 3.35 hours per credit. All right. So if you want to move forward with public service loan forgiveness, here are the next steps to apply. And I want to preface this by saying we have changed the order of these steps. The order still starts with confirming employer eligibility, because PSLF is about public service loan forgiveness. If you don't work for a public service employer, you don't get the loan forgiveness. Next, we usually recommend that people look at their loans. But now that the PSLF Help Tool has been enhanced, that part is actually done for you after you begin the process of certifying your employment. And after the Help Tool provides you with the recommended actions, then you have a decision to make. Are you going to follow through with those recommendations? And in some cases, you really don't have a choice. So we're going to walk through all 4 of these steps. The first step is critical, and that's to confirm your employer eligibility. This particular question came in from Prince George's Community College, and PGCC is a qualifying employer for the purposes of public service loan forgiveness. For any other employer, you want to use the employer ID number, or the EIN, which can be found on your W-2. And you want to look this up for every employer that you worked for after October 1st of 2007 while you had loans. So once you have those EINs, you want to go to studentaid.gov/PSLF. You can search for qualifying employers and enter the EIN to see the result that comes out of the database. If the organization is eligible, you usually see a little green, I'm not sure if it's green anymore because they've changed some things, but there used to be a little green tag there that said eligible. Then some of them were yellow, like undetermined or likely ineligible. If you see something that says undetermined or likely ineligible, for some people, they might say, that's enough, I'm just not going to apply. If you know that the organization is a 501c3 nonprofit organization, and performs certain services for the public, then you can submit documentation to support that. And you might just change the classification of the organization within that database. You never know until you try, so don't write yourself off. If you see ineligible, then odds are your employer is ineligible. But in some cases, I've seen some employers who have changed their status from for-profit over to nonprofit. So they might have been ineligible before, but now they are eligible. So just make sure that you're doing your research. The database is pretty good, but it doesn't include everything. So if you see one of those answers that's anything other than eligible, make a judgment call, do some research on the organization, and if things are kind of up in the air, submit some documentation and see what happens. But I can tell you for sure, if it's a for-profit organization, it will not qualify, so don't waste your time with those. All right, so step 2, that is to certify your employment, and it's important to submit an error-free application. If you use the PSLF Help Tool at studentaid.gov/PSLF, then that will really cut down your chances of making mistakes. Now, for each employer, each qualifying employer that is, you're going to need some information. The first thing you're going to need to know is your official start and ending employment dates. You'll also need to know the average number of hours you worked per week. And special note here, a lot of us work more hours per week than we're supposed to work per week. So if you're working 60 hours a week, even though you're only supposed to work 40, you need to put down 40, because your employer is not going to certify that you work 60 hours per week, because you're not bound to work 60. You're supposed to work the 40. So this is the actual number of hours you're supposed to work per week. You also need to know whether you are full-time or part-time. And you should have the contact information for a person from the organization who will verify the above details of your employment. Sometimes this person will be referred to as an authorized official. This could be someone from human resources, payroll, benefits, or it could be your manager. Anyone who has access to that information, enough access to verify it, could sign the form for you. Once you have all of that information, then you can get started adding the employers. You're going to use their EIN, and then the database will show you, this employer, like if it's PGCC, this employer is eligible, and then you'll be able to move on and fill in your employment details. After you've added all of the employers, verified your personal contact information, and signed the form electronically, you're going to have to select an option to get it verified. You can select the manual option, which would mean that you'd need to send the form to an authorized official so that they can sign it and then give it back to you, and then you would be responsible for sending it to Mohila. Or you can select the electronic signature, which uses DocuSign. This is a much more convenient option, because if you choose this option, the form will be emailed to the person, and once they have signed it, the Department of Education will take care of making sure the application gets to Mohila. So if you have contact information for someone, which includes the email address, I would recommend just reaching out to them first, perhaps to let them know it's coming, and please do sign it as soon as possible. And then you won't have to worry about like some teachers that I've dealt with last summer had moved around and worked in several districts, had to physically take a form to these different headquarters offices to get someone to sign it. And I'm thinking about several of them now, and it worked, but it's just a lot more easier now. All right, let's move on to step 3. So within the PSLF Help Tool, after you have completed the PSLF application and the signature selection for the verification, you'll see recommended actions. The form will let you know that you're not finished yet. There's more to do. One is that the employer needs to sign, but 2 is that you may have to take actions with your loans to get them on track for PSLF. So some of the common recommendations that I see, one is to consolidate ineligible loans. So if you have FELP loans or loans that are not direct, it's going to instruct you to consolidate those loans so that they can become eligible for PSLF. The other one that I've seen is get out of deferment or forbearance. And for many of us, we have been in a forbearance since March of 2020. And the time in that forbearance can count toward public service loan forgiveness if you have the employment. So you can not worry about that too much right now because we're in a CARES Act forbearance. But if this were later on and you wanted the time to count toward PSLF, then you'd want to take action to get out of deferment or forbearance. And the last one is to enroll in an income-driven repayment plan. The income-driven repayment plans are the safest when it comes to making sure that your payments qualify toward PSLF. So the Help Tool recommends that if you're not enrolled in an income-driven repayment plan, that you become enrolled in one. So I want to dig a little bit deeper into those recommended actions with step 4, and we'll walk through all 3. The first one that I see a lot is consolidation. If you have non-direct loans, then you don't have a choice. If you want to apply for public service loan forgiveness, then the loans have to be consolidated to even be considered for PSLF. And the consolidation loan application is online at studentaid.gov. If you have direct loans, then you don't need to consolidate, but it could be advantageous for you during this IDR adjustment to consolidate them and bring them all onto the same repayment clock. This could be especially useful for people who have multiple degrees or took some time off from school, worked for a qualifying employer, and then went back to school again and took out loans in both stints. If you have these loans that have differing amounts of repayment history, you can consolidate them now, and the consolidation loan will be given credit for the history attached to the oldest loan in the portfolio. So in the example on the right, you got 2 consolidation loans. One has 96 months of repayment history. The other has 140 months. And when they're consolidated together, all of the loans are brought up to that 140-month mark. So if you have all direct loans, but you know you had some gaps in between borrowing loans, you might want to go ahead and consolidate those to get the benefit of that oldest loan's repayment history. As I mentioned before about the deferment and forbearance, if you're completing this application now, you're going to see that because we're in a forbearance. But that forbearance is one that was decided upon by the government, and that time counts as long as you have the qualifying employment. After the CARES Act forbearance is over, you'd want to make sure that your loans are in repayment. And lastly is to enroll in an income-driven repayment plan. If you want your future payments to count toward PSLF, you should enroll in an income-driven repayment plan by year end, so that as of January 2024, you can make sure that your future payments are on track for PSLF. All right, so speaking of on track, to get on track for PSLF, the first step is to submit your PSLF application at studentaid.gov/PSLF. For PSLF, you need to have a minimum of 120 months of qualifying employment as well as repayment history. If you know that you have 10 or more years of history, it's possible that your debt could be canceled without future payments. We're getting to a point where that might not be realistic since payments are set to resume in October, but any overpayments you make on a direct loan would be refunded. If you have less than 10 years of employment and repayment history, you still should consider applying for PSLF ASAP because you might receive additional credit for payments that would not have been considered eligible under normal circumstances. If you're already on track and you want to stay on track, here are a few tips. 1, keep the public service employment. You want to make sure that you remain working for a qualifying employer. The second tip is to submit the PSLF application every 12 months and or when you change jobs. You don't have to stay in the same job, you just need to stay in the realm of public service employment. Next is to stay enrolled in a qualifying repayment plan. The income-driven repayment plans are usually the safest ones. For most people, they're more affordable than the fixed plans, and they also qualify for PSLF. Fourth and finally, after you have made your 120th qualifying payment or you've reached that 120th qualifying month, submit the PSLF application one last time. And once your application has been approved, you can expect that the remainder of your debt will be discharged. Just a quick note about why it's important to really recognize the value of this IDR adjustment, the greatest benefits of which will be available for people who apply to consolidate by December 31st of this year. Forbearances and deferments can count. That's not something that usually happens. For forbearances, we're looking at lengthy ones, those that are 12 consecutive months or more, or over the life of the loan, 36 cumulative months or more. Deferments prior to 2013, some of them can count. Periods that do not qualify, though, are periods of in-school deferment, grace periods, and time when the loans were actually in default. But pretty much everything else is up for grabs. All right, we have another question about an adjunct faculty member at a community college who wants to know, is there any possible student loan debt forgiveness available to me as a part-time faculty? I want to remind everyone, public service loan forgiveness requires at least 30 hours per week on average. This doesn't have to be consecutive months. You can have breaks, like if you only teach fall and spring, then the summer would not count for you. But that doesn't mean that it would negate the fall and the spring that you previously worked. So for adjunct faculty members, PSLF can be possible. It would just be for periods where you've met that 30-hour threshold. And for many adjunct faculty members, you're usually teaching at more than one institution. So if you can combine those roles of the two institutions together and breach that 30-hour per week threshold, then that can count toward public service loan forgiveness. And as a reminder, employers should use 3.35 hours worked per credit hour taught per term. So if you teach a 6-credit class in the fall semester, then for your PSLF application, you would put on 20 hours. Sometimes employers are not necessarily aware of that, so you can tell them that. You can refer them to us, or even some of the laws that are out there in other states. And this is a good point to mention that this past legislative session in Maryland, I was working with the Cash Campaign of Maryland and Student Borrower Protection Center on a bill that would have provided employers with additional information about this and made it so that the 3.35 hours worked per credit hour would be standard. Unfortunately, the bill didn't make it out of session. I'm hopeful that we will push for it again in the next session. But if you are an adjunct faculty member, I encourage you to speak with HR, your department chair, and just share with them your experience in applying for PSLF if you have already. And just let them know 3.35 hours. Let's make this very clear for people who are adjunct faculty members so that they can have a pathway to public service loan forgiveness as well. Also, from experience working with an adjunct faculty member who had different loads each semester, we actually took a look in her account on Mohila's website, and we found that one of the institutions she was teaching at was not certified. It was listed as an employer, but we didn't see any of the employment reflected in her employment history. So what we had to do was go to studentaid.gov and fill out a PSLF application for each semester that she taught, because there were different numbers of hours per semester. And we had to go back to, I want to say 2015. I think it was 8 years of history missing. So I'm hopeful that very soon I will be able to report the victory for that adjunct faculty member, because with those multiple assignments at different institutions, once they're combined, I know for sure that she will have met that 30-hour threshold per week. So yes, for adjunct faculty members, it is possible. You just have to meet that 30-hour threshold. All right, next question was, what is the best way to pay back parent loans? It really depends on your situation. So I just wanted to start out with the difference between income-driven plans and balance-driven plans. So for the income-driven plans, these are the plans that will get you on track for cancellation by way of income-driven repayment, as well as public service loan forgiveness if you work for a qualifying employer. So with income-driven plans, you have to provide answers to questions about your family size, your tax filing status, adjusted gross income. The length of the repayment term may vary, but if you strictly are repaying Parent Plus loans and you use the income-driven route, then it's going to be 25 years. You have to answer those same questions every year and your payment will be recalculated. On the other hand, you have balance-driven plans. With balance-driven plans, the amount that you pay each month is based on how much you owe, and you could select different repayment terms. Some consolidated loans I've seen offer a 30-year term depending on how much you borrowed, but 25 years is usually the max. And again, that is the length of time required for cancellation by way of income-driven repayment. So really, I can't tell you what's the best way to proceed. If you are looking for public service loan forgiveness, then the income-driven route would probably be best, because that repayment plan would qualify for PSLF. And if you have the employment, then you could cut this thing from 25 years to 10 years. If public service loan forgiveness is not an option for you, then perhaps a balance-driven plan might be more appropriate. But it really depends on the types of loans you have, your career, and your cash flow. Those are kind of the big factors that I think about when it comes to selecting a repayment plan. So it's truly a very personal decision. But if you know that public service loan forgiveness is on your radar, then the income-driven repayment plan would be most favorable for you. With the income-driven repayment plans, I just want to remind you that for Parent Plus loan borrowers, income contingent repayment is the only repayment plan that's available. It also happens to be usually the most expensive repayment plan. It has a repayment term length of 25 years. And if the Parent Plus loan borrower is pursuing loan forgiveness through income-driven repayment, then that forgiveness could come after repayment of 25 years, and will cover whatever the remaining balance was. If the person is pursuing public service loan forgiveness, then that repayment term could be cut down to a minimum of 10 years. But just keep in mind, for Parent Plus loan borrowers, if you do choose to go the income-driven route, you only have one option, and that option is ICR. All right, the next question has to do with income-driven repayment again. I see in my servicer account that I was enrolled in REPAYE and now I'm in SAVE, but the payment looks the same. Is that correct? So SAVE is a work in progress. That's probably the best way to describe this situation. According to the Department of Education, SAVE will go into effect fully on July 1st of 2024. Parts of it that are coming in summer of this year include: 1, the income exemption rises from 150 to 225%. This is important because the current formulas for income-driven repayment, they basically exempt a portion of your income. It's, well, the difference between your income and poverty guidelines. So by taking that exemption from 150% up to 225%, that means more of your income is left alone. It would not be considered as available for your student loan payment. The second thing that's supposed to happen this summer is that they will no longer charge for interest that isn't covered by the borrower's required payment. So if interest is accruing each month on your loan of $100, but the payment that you are required to send only covers 50 of those dollars, in a normal circumstance, you have 50 more dollars that balance is growing each month because the accrued interest is not being covered. With SAVE, they're no longer charging for that interest, and we'll see how that works after repayment resumes. Also, for married borrowers who file separately, they will no longer have to include the spouse's income in their payment calculation. So that's all that we're supposed to see this summer. Next summer, we should see that reduction from 10% of your disposable income being available to go towards your payment down to 5%. But that only applies to undergraduate loans, people who have undergraduate loans only. If you have both undergraduate and graduate school loans, they're supposed to use a weighted average based on the original principal balance of those loans. But the amount is supposed to never be more than 10%. So for folks who have a combination of loans, it'll be somewhere between the 5 and the 10. Now, based on what they're saying is supposed to come, this year versus next year, I do think that the payment should go down. And I say think because I have not seen this yet. I think the payment should go down because if the income exemption is phased in this summer, that means that more of your income is supposed to be protected. That implies that the payment should go down, but it will not go down as far as it will go down in July of 2024 when we see that 5% cap. Right now it's 10%. So I hope to see the payments go down to reflect that income exemption, but we're not really going to see the full effect of SAVE until that 5% cap is implemented, because right now the cap is at 10%. All right, so coming in 2024, I'm not going to read this entire list, but I just wanted to share with you the other parts of SAVE that are expected to go into effect next year. And the first one on that list is that payments on undergraduate loans will be cut in half. That's a reduction from 10% to 5% of income above 225% of the poverty line. So we can expect that piece to go into effect next summer. And if you are in REPAYE and transitioned into SAVE, then I would expect that you'd really see the difference in your payment next summer. Speaking of repayment, it's time to get ready. The end of this month is when the payment pause technically ends. Interest is set to start accruing September 1st, and payments are going to resume after October 1st. So we need to make sure that everybody is ready for repayment, because after all, it's been more than 3 years without it for many of us. So to get ready, please log into studentaid.gov. There you can view your loans, view your servicers. You can also view the repayment plan you are currently enrolled in and apply to change it if you'd like. Look at the payment that your servicer expects you to make and ask yourself, is the payment affordable? Also keep in mind that that payment could be updated once we see that implementation of the income exemption changing. But is it affordable? And if it's not, take a look at your options, including income-driven repayment plans. You want to make sure that your most accurate contact information is updated within studentaid.gov, as well as with your loan servicers. Commercially held loans were not included in the payment pause. So for those of you out there who have been paying all along, nothing should change with your commercially held loans. But if you also have federally held loans, then the change will be that now you're responsible for making both of those payments instead of just one. If you have those commercially held loans, you might want to consider consolidation to benefit from the IDR adjustment. I do want to take a moment to say, though, that I do not give blanket advice to people to just consolidate no matter what. Consolidation is truly a personal decision. There's some people that I've worked with where consolidation would not have benefited them because they earn too much money relative to what they owe in student loans. So the income-driven repayment plan would actually place more of a burden on them if they were to enroll in it and wait for cancellation that might not come because they pay off the loan faster on an income-driven repayment plan. So consider it. But remember, I'm not telling everybody, no matter what kind of loans you have, consolidate them to get in on the IDR adjustment, because for some people, it's just not going to make sense. All right. So I want to wrap up with where to go for accountability when it comes to your student loans. And some people would like to file complaints or start investigations. I recommend visiting the Consumer Financial Protection Bureau online at consumerfinance.gov. They have a complaint database that you can review as well as submit a complaint to. The Department of Education has an ombudsman's office where you can submit complaints, but you just need to make sure that you have tried other avenues, like directly with the servicer first. And if you feel like you're not getting anywhere, I shouldn't say if you feel like, if you are not getting anywhere and resolution is not coming, then you might want to reach out to the Department of Education's ombudsman. You can go online to studentaid.gov, look at the ombudsman's website and see if your concern is one that would be handled under their purview. That also includes a PSLF reconsideration request. I've said many times, for people, if you've just consolidated, you want to hold off on submitting a PSLF reconsideration request because of the way that the counts work. But I just came across someone last week who has 4 loans. 3 of the loans have reached 121 qualifying payments. The 4th loan, which has been in repayment along with the other 3 loans the whole time, has like 98 payments that are listed as ineligible. That makes no sense. All the loans have been in repayment since 2013. So all of the loans should be at 121 qualifying payments. The person is, waiting on the servicer to update their records. But if that's something that does not change, perhaps that's a situation where a PSLF reconsideration request should be submitted, because obviously something is wrong with that count. At the state level, Maryland is a state that has its own student loan ombudsman, and you can visit the ombudsman online at the Department of Labor to help you with problems you might experience with your servicer, including failure by the servicer to communicate with the borrower, errors in crediting principal and interest payments, misapplied payments, inaccurate interest rate calculations, billing errors, loan consolidation or modification errors, and or inappropriate collection activity or tactics. So you've got options at the federal level and at the state level, but the best place to go first is your loan servicer to see if you can get resolution that way. As I mentioned, you can visit the Maryland Student Loan Ombudsman online through the state's Department of Labor. You can also see the Maryland Student Loan Borrower's Bill of Rights to learn about the protections to which Maryland borrowers are entitled and the obligations of student loan servicers. All right, so we have answered all of the questions that were submitted since our last edition of Office Hours on July 26th, and I have got to say, these were some hard ones. This is a fluid situation, with the IDR adjustment, which can affect public service loan forgiveness. And there's just a lot going on right now. So we're doing our best to share information with you that is accurate and timely, but just know that things are changing. We're just trying to keep pace. If you have any questions, you can reach out to the Maryland Center for Collegiate Financial Wellness online at mccfw.org. There I am. Okay. You can reach out to us at mccfw.org. There's a contact form there where you can submit questions or join our mailing list. On the office hours page, there's also a form for you to submit your questions. And if we answer your questions during office hours, we'll reach out to you and send you that video clip along with an explanation. I did not see any questions in the chat, so I think we're good to go. I want to thank you for joining me for the August 9th edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. If you have any questions that come up in between this and our next edition, which will be on August the 23rd, you can, again, visit us online at mccfw.org to fill out that contact form. You can also follow us on social media. We are on Facebook, Instagram, Twitter, and YouTube at the MCCFW. And I would like to just give a quick shout out to our subscribers to our YouTube channel. The community is growing, and it's just good to know that we're sharing information with people that they need and appreciate. So if you have not subscribed yet, please do go on over to YouTube and subscribe to the Maryland Center for Collegiate Financial Wellness, and expect that within 48 to 72 hours, this particular episode will be uploaded to YouTube and annotated so you can go straight to the content that concerns you in the future. I'm going to check the comments one last time to see if we got anything. And it looks like we're all clear. Yep, I think we are good to go. In that case, I'm going to go ahead and sign off for this evening. And as always, until next time, be well.